Welcome to the short executive knowledge lecture on topic 7, paper 2 of the SFC licensing exams. This topic covers market misconduct and improper trading practices. Now, this was topic 9 at paper 1, and there is a great deal of overlap between the two. So if you've done topic 9 recently, paper 1, you will have covered a great deal of this. If not, it's not technically demanding, and I intend to be covering it in just one lecture as opposed to two. As ever, I will emphasize the important points to help you understand the core material you need to know, sit the exam, and a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Paper 2 Resources. And as ever, to help supplement your study, I strongly recommend that you do the practice questions that can be found on the platform Examinator.online. Now, what have we in store? The regulation of market misconduct. Well, first of all, we'll look at the 6 categories of market misconduct and how they are dealt with. The consequences of market misconduct. You either are up in front of the courts or you're in front of the Market Misconduct Tribunal. We'll then consider unsolicited calls. Now, at paper 2, topic 7 is fairly uniformly examined. So you're going to get something on market misconduct. You're going to get something probably on Market Misconduct Tribunal. You will definitely get something on unsolicited calls and possibly on improper trading practices. So there's a fairly good return for your time spent on studying topic 7. So there are at the top of page 3 the 6 categories of market misconduct: insider dealing, false trading, price rigging, stock market manipulation, disclosure of information about prohibited transactions, and disclosure of false or misleading information inducing transactions. Now, each of the 6 is defined under section 2, and I'll leave you to read through it. It's not that demanding. I may highlight 1 or 2 points when I get there. Now, the point of all this is that the SFC considers market misconduct to be more serious than just misconduct, because you're bringing the Hong Kong market into disrepute, and as a result, they can be pretty heavy-handed with you. Now, are they going to prosecute you under criminal or civil law? Well, it will be a decision initially made by the SFC, and then it will be confirmed by the Secretary for Justice. Now, if they take you down the civil route, which is on the left on page 3, your case will be heard by the Market Misconduct Tribunal, and the level of proof that will be used is the balance of probabilities. If, on the other hand, they consider it more serious, you will be taken down the criminal route, and your case will be heard in a court of law. And there, the level of proof will be beyond reasonable doubt. Now, there is no double jeopardy. You cannot be taken down both routes. So if you go down the civil route, you cannot be taken to a court under the criminal route, and vice versa. If you're taken down the criminal route, you cannot be taken down the civil route. However, in addition to either civil and criminal prosecution, you could have a private case, a private civil case brought against you. And somebody would sue you for damages. Okay, page 4, there is the definitions of insider dealing, which includes tipping off, what insider information is, and who connected persons are. A lot of it is, I would suggest, common sense. Section 2.1.2, there are some defenses against the charge of insider dealing, which are listed there. Now, the ones that are vague tend not to be examined. For example, the third one, that the dealing was a market contract. What do they really mean by that? It's not defined in the study notes, and as a result, we've never seen it examined. The others are reasonably straightforward. And there's the definition of false trading, price rigging. They say that price rigging is a subset of false trading, which sometimes upsets people. They say, well, why not just call it all false trading? Well, false trading is giving the appearance of active trading for whatever reason, and two methods, wash trade and matched order. Whereas price rigging is specifically, it's not so much to give the impression of active trading, it's specifically to move the price, or indeed keep the price as it is. Stock market manipulation is fairly broad. Now, what's in the box on page 6 is fairly important. False trading, price rigging, and stock market manipulation, as defined in the Securities and Futures Ordinance, covers transactions carried out anywhere in the world with regard to Hong Kong stocks, and in Hong Kong with regard to any market traded instruments, whether they're Hong Kong or overseas. Now, those 2 points are specifically put into legal wording in the box, but remember that those offences apply in Hong Kong or anywhere in the world with regard to Hong Kong stocks, and in Hong Kong with stocks anywhere from the world, in the world rather. The easier way to remember this is that if you are dealing in an overseas market, you are overseas and you're dealing with overseas stocks, then I think it's quite obvious that the SFC regulations don't apply. Sections 2.5 and 2.6 give 2 further definitions. And 2.7, this is just an expansion of what I've just said. The controls over market manipulation extend to conduct in Hong Kong, which affects overseas markets, conduct overseas, which affects Hong Kong markets, and insider dealing in Hong Kong listed and dual listed securities. Okay. Safe harbor rules. They protect certain activities from being labeled market misconduct. And the main one, indeed, I think it's the only one, is the price stabilizing rules, which allows the price stabilization of a new issue, a public offering, for the first 30 days from the issue, to support the price if the price falls below the offer price. You're not probably going to be examined in detail on price stabilizing in topic 7, but it is a concept under safe harbor rules. Fraud and deception, anything to do with fraud, it's going to be criminal prosecution. Disclosure, in paper 2, they put this in topic 7. In paper 1, it was in topic 3, disclosure of inside information. Now, this is looking at insider information from the other side, from the listed company's point of view. So if a listed company, the officers of a listed company become aware of price-sensitive information that is not yet public, they have an obligation to make it public knowledge as soon as possible. And if they don't, if they breach the disclosure requirement, they can be liable to fines. I don't think there's any imprisonment there. Right at the bottom of page 7, it says listed corporation and or directs may be subject to civil liability or a regulatory fine of up to 8 million and or other sanctions. Now, there is an exemption to the disclosure of information, and that's to do with takeovers and mergers, and that is covered if you look at the 3rd bullet point under section 2.10. Exemptions to the disclosure requirement include, and I'm going to drop down one, confidentiality, the information is preserved, and the information concerns an incomplete proposal or negotiation. So that covers the instances of mergers, takeover conversations being had while you're not forced to make them public. Moving on to section 3, consequences of market misconduct. You can find yourself in front of the Market Misconduct Tribunal, which is dealt with in section 3.1. I talked about the Market Misconduct Tribunal earlier. There's a little bit more detail under section 3.1. 3.2 covers the orders that the tribunal can make, and just running through them, you can see They can disqualify someone for up to 5 years from holding office. They can prohibit someone from investing or trading in the Hong Kong markets for up to 5 years, the cold shoulder order. The cease and desist order, that is a prohibition of further market misconduct, which makes a lot of sense. Payment of profits made or loss avoided, plus interest to the government. Payment of reasonable costs incurred by the government and the SFC, and any disciplinary referral orders to other professional bodies. Now that's the orders made by the Market Misconduct Tribunal under civil law. Under criminal law, the courts can hand down sentences of up to 10 years imprisonment, 10 million fine, 3 years imprisonment, 1 million. The first one was on conviction and indictment, which is a judge and jury, a bigger case. And the second one, summary conviction, which tends to be a district judge or a magistrate making the judgment and handing down the sentence. Now, I touched upon private civil actions earlier, and there it is in section 3.4. So on top of either civil action, criminal action from the SFC, you could also have a private civil action in addition, and the notes are there for you. Now, I said there's a very good chance for a question covering unsolicited calls. This is cold calling. Now, it is an offence to cold call where you're trying to sell something, and that is covered by the third main bullet point. We're told it's an offence to engage in the following acts during an unsolicited call. That is, someone does not invite you to call, and the call is either by phone or in person, and it's to offer to make agreements to buy, sell financial products, offering security margin financing, and offering to provide profits, income, or other returns from it. So it's where you are calling uninvited and you're trying to sell something or make money. That is illegal. You are committing an offence. However, there are exemptions, and the exemptions are just above. Persons exempt from prohibition. In other words, you can cold call these individuals, existing clients, licensed persons, registered institutions, well, that's all intermediaries, PIs, professional investors, solicitors, accountants, where they're acting in their professional capacity with regard to the call, and money lenders. All of those can be called without it being illegal. Now, remember that the offence is with regard to trying to sell something. If you're cold calling to set up a meeting, that does not come under the legislation that we are dealing with here. Okay, there's some other bits and pieces that are covered, and I would be aware of those. Improper trading practices under section 5, they list the different improper trading practices. How would this be examined? Two ways. First way is that they ask you which of the following are market misconduct, and they will list maybe 1, 2 from the 6 categories of market misconduct, and then they'll throw in some improper trading practices. Improper trading practices are not market misconduct. So they're on a micro scale as opposed to macro. They don't bring the whole market into disrepute. You may be risking your license. The practices can also be illegal. The other type of question is drilling into one of them and examining you on what the trading practice means. So running through them quickly, boiler room activities is the use of high pressure sales tactics to sell securities, usually combined with cold calling. Churning is where you're buying and selling investments in a portfolio to generate broker commissions, and it's not in the interests of a portfolio client. Corporate misgovernance is the opposite of good corporate governance. The company is being run in a way that disadvantages one or more of the stakeholders. Front running is where you act before the clients can act in a transaction. So you have knowledge of the underlying companies or what the client is going to do, and you go in before the client. That is an improper trading practice, front running. Rack trading is where you trade to the disadvantage of your client. For example, in a rising market, you go and buy some securities that you know the client is going to buy a little later, and then you sell them on at a higher price. That is considered rat trading. Unsuitability, your recommendation is unsuitable for your client with the knowledge you have of the client. And unauthorized trades is exactly as it sounds. The trade that you make on behalf of a client has not been authorized by the client. Paper 2, we got section 6, the SFC disciplinary finding guidelines, and you will see that the SFC can be more lenient if you cooperate with the SFC and be aware of the particular situations that they highlight. And then finally, section 7, enforcement actions. Again, these are examples of enforcement actions that have been taken by the SFC. They're not going to examine these specifically, but they just expand upon the material that you have been studying throughout paper 2. Once again, if you're getting ready for answering questions in topic 7, question practice is invaluable, and I recommend Examinator.online. That brings us to the end of paper 2. Paper 2, remember, has got 40 questions. You need to get 28 or more correct to pass. Read the material, listen to these lectures, do the question practice, and you should be in pretty good shape. Good luck.